Hi, hello everyone. My name is David Stuff. I'm the Managing Director of Oak Funds, and we're delighted to be invited by IPP to talk to you today about our new Oak Multi-Asset Funds and the income solution that we offer within this range. The Oak Multi-Asset Funds are a new range of funds that we've developed where we have guidance from BlackRock. So BlackRock provide the asset allocation that we use within the fund range. So what we'll be doing in this webinar is I'll be giving a little bit of an introduction in terms of how the funds are set up, what we do, what BlackRock does, and so on. I'll hand over to BlackRock, who will then provide an overview of their view of markets. So 15-20 minutes, BlackRock can tell you what their thoughts are and how they see equity and bond markets panning out and what's driving the asset allocation that they have. And then I will take the webinar back and we'll talk to you specifically about how we are able to deliver a 4% income for you and your clients going forward. So that's going to be the broad thrust of what we do now. The whole presentation should be about 40 minutes. There's time for Q&A afterwards. So if you do have any questions, please use the chat function and we'll try and pick up as many of your questions at the end of the presentation as we can. So without further ado, let me just get into the presentation and I'll talk to you about what we're doing at Oak and how we work with BlackRock. The Oak Multi-Asset Funds are funds that offer diversified exposure to equities, bonds, and alternatives. They're the classic funds where we're using the diversification benefits as equities go up and bonds go down. They provide diversification benefits. And we have got three funds, three risk-rated funds. So we have a lower risk, a medium risk, and a high risk fund within the range. For each of the funds, the asset allocation is based on guidance from BlackRock. And as you can see on the slide, BlackRock are the largest investment manager in the world. $8.7 trillion of assets under management at the time we did this presentation. I think the number, and Andrew will be able to confirm this in a minute, I think has just gone over to $9 trillion. And to put it into context, that's about 4 times the total market capitalization of the FTSE 100 index. BlackRock has 70 offices in 30 countries. 16,200 employees, and it's definitely the biggest and I think most respected asset manager in the world. And it is BlackRock that is providing the asset allocation that drives the performance of the Oak Multi-Asset Funds. Our funds are UCITS funds. Now, UCITS funds mean that's the highest level of investor safeguarding. UCITS funds are an internationally recognized standard for the best funds in the world. We have daily liquidity. The fund, you're able to buy and sell investments in the funds whenever you want. And we have multiple share currencies. So we have Singapore dollars, euros, and sterling. So investors in different currencies can invest in the share classes that are most appropriate for them. I'll let Andrew talk a little bit more about the BlackRock investment philosophy. But safe to say that BlackRock have an enormous investment capability, a huge investment team, do detailed fundamental analysis on global markets, and that's really the process that is driving their the asset allocation advice that we get from them. But let's look at now at the problem facing income investors. It won't be a surprise to anyone that interest rates are at all-time lows, and in all probability, even though we started to see a little uptick in inflation, the probability is that interest rates are likely to remain low and very low for some time going out in the future. The return from sovereign bonds, government bonds, is extremely low and in many cases negative, and so you either have negative nominal yields, and in many cases there are negative real yields. So once you take inflation into account, then even more sovereign bonds are actually offering negative returns. We've also seen that the additional returns that people get from taking credit risk is also low. So if you're investing in bonds issued by companies that are less creditworthy, you're getting less of an upturn, less of an uptick in return than you have done previously. So for bond market investors, the whole bond spectrum is offering less of an income than it's done in the past. Now, what you've now got is that is also combined with the problems that COVID has generated, and the shutdown the governments have imposed as a result of COVID, which has caused many companies to cut dividends. And in many cases, dividends have been cut significantly. And compounding on that, we've also seen the yields or the values of shares that have high yields have also been both volatile and fallen quite significantly as well. But one of the other problems, I think, for income-seeking investors is they've not been able to necessarily benefit from some of the high growth companies that we see around the world. So income-seeking investors haven't been able to enjoy the benefits of owning Apple or Facebook or Google. They haven't been able to participate in the high growth sectors because typically those high growth sectors are not high dividend payers. So as a result, income portfolios have been volatile. In many cases, we've seen significant reductions in capital value, and the so-called natural income, that's the interest that people have received on bonds and the dividends they receive from equities, has declined significantly. And as a result, we've seen a lot of income-seeking investors having to take on increasing amounts of risk within their portfolios. So if we look specifically at what's happened with COVID in the last year or so, COVID has had a particularly negative impact on income-seeking investors. What we've seen is that interest rates as a result of COVID are going to be lower for longer. Real yields are expected to fall further as inflation increases. BlackRock anticipating that there will be some uptick in inflation around the world, but that bond yields won't increase by as much as would normally be the case. And so as a result, they're looking at the possibility of negative real yields. And the global dividends are overall $1.6 trillion lower in 2020 than they were in 2019. So for income-seeking investors, the environment has been, I think, very, very tricky indeed. And we can look at this in a bit more detail. The slide on the left shows the yield on longer dated bonds, and you can see that there have been significant declines in the yield on longer dated bonds. And although there's been some uptick recently, these yields are still at sort of almost at unprecedented lows. And on the right hand side, we look at what's happened on FTSE dividends, and FTSE dividends have been cut significantly as companies have responded to the slowdown. Economic conditions obviously very tight, and that resulted in many of the UK companies cutting their dividend payments. So another way of looking at the problem facing income-seeking investors, and I don't mean to depress people too much at this stage, but what we can do is we can look at the yield you get on different asset classes, and in order to illustrate this, what we can look at is the yield on different asset classes. And what I've done is I've picked up here the yield from different iShares, and we can see that the yield on high yield bonds is 4.73, the running yield. But if we look at the yield to maturity, you can see that the yield to maturity, even on high yield bonds, is only 3.09%. So, and if we take that down, high dividend shares are around 4%, high yield bonds 2.55%, UK equities still high yielding asset, and we've seen a lot of investment in equities from income-seeking investors, but that comes with the risk of increased volatility as well. And that drops down all the way down, and you can see the yield on bonds is only 0.85 and 0.37. So this is a real problem for income-seeking investors. So what I'm going to do now is I'm going to hand over to Andrew Keegan from BlackRock. And Andrew will talk to you for the next 15-20 minutes about BlackRock's view on equity markets and bond markets. He will talk to you about how their portfolios are being positioned. And then I will come back and for the last 10 minutes or so of this presentation, I'll talk to you about how we have developed our income solution for you and how we're able to deliver a 4% income solution. So without further ado, I think Andrew is ready. I'm going to stop my screen and Andrew will take over. And Andrew, I will leave the floor to you.
Thank you, David. Can you hear me okay?
Andrew, loud and clear.
Perfect. Okay. Look, just you mentioned BlackRock's assets, and yes, we did cross that 9 trillion, and that is only in thanks to our clients for trusting us and entrusting us with their assets to manage. So again, I appreciate having me on the call today and speaking around BlackRock's views, which, you know, if in the time I have, of course, there's lots going on in the world and I'd love to spend longer, but you know, if we look at, you know, how we're positioned maybe versus the street as a kind of starting point, you can think about from a macro perspective, you know, assets like, you know, Japanese equities, you know, starting with, you know, the market. Generally, we've been underweight. I would say it's probably our most contrarian view versus the street in terms of, you know, what you see in sell side research. The street's been very positive in Japan, favorable valuations, looking at, you know, cyclical markets, high sensitivity to developing market yields, as you mentioned earlier. We've been a bit more cautious, although to be fair, very recently we have brought that back to a more neutral view. You know, obviously we've seen the stronger yen amid the potential US weakness weighing on Japanese exporters. I guess the other kind of, you know, bigger kind of, you know, market asset class view around EM equities. I think we're, I would say, more aligned to kind of broader street views here. So emerging market equities is positive for us. I think what we'd argue is selectivity and kind of see EM Asia as a kind of primary growth driver, although we do see some of the sentiment in China, you know, turning negative, and therefore we'd be looking to be a little bit more reducing that. Clearly, you know, the region has rebounded faster than developed markets, and again, you know, Asia in particular does benefit from that tilt to technology. Emerging market debt, again, views are mixed. Hard currency emerging market debt amid the headwinds of rising US real yields. From a macro view, we see, you know, a more predictable US trade policies as a stabilizing factor. EM local may also be supportive of a weaker dollar. European equities, and I think we can think about European equities and UK equities here, but the views diverge. You know, I think some are expecting from a kind of Europe-specific EU a large boost to Eurozone growth in H2 from vaccine progress and a dovish ECB. You know, we prefer other kind of developed market areas. And I think to get onto where we are most overweight from a view perspective is and continues to be US equities, supported by positive earnings forecasts. You know, government stimulus and strong tailwinds from, you know, the key drivers in our investment process, which is a combination of a quantitative and a fundamental insight, but looking at valuation, looking at, you know, economic and sentiment data. As I said, we talked a little bit about China, despite disappointments around the GDP growth. You know, we maintain that overweight in emerging markets, viewing EM valuations as attractive, again, particularly versus other regions. And again, supported by that weaker dollar. We talked about Japan. UK is broadly neutral. Again, you know, we've seen the UK vaccine rollout. I'm obviously based in London. I've benefited from that. And a phased reopening plan. Again, very happy to see that. You know, we see definitely reasons to be more positive. However, we do again see this potential Brexit-related impacts. We're seeing this, you know, regionally with exports, whether it's, you know, export challenges to the EU, and we expect that to continue and beyond. So, you know, it can't be ruled out, and therefore we're refraining from going overweight, despite the kind of, you know, the natural kind of value, you know, value tilt that we see in the UK. So that's the kind of broad kind of macro view in terms of putting us in position versus the street and any kind of views that you're probably familiar with. You know, if you delve into the portfolios, you know, across our kind of global portfolios, we will generally try to stay diversified. You know, we have the, you know, the breadth and depth of the iShares ETF range to maintain diversification within equities, maintain diversification within, Bonds, again, that challenging part of, we're able to play different curve positions rather than just be exposed to duration. We're able to continue to diversify with corporate bonds. And again, increasingly, and you'll read this from, our CEO, Larry Fink, we do and have taken to our heart sustainability. We see climate risk in particular as investment risk. Oh, can you see and hear me?
There we are, Andrew. Lovely. That's very good.
Sorry. Okay. Sorry. So that's and hopefully you got what I said before, David. Yeah.
Yeah. We could hear you. We just couldn't see you.
Right. I'm not a pretty picture, so you didn't miss anything. The climate risk is investment risk is important, and it's something that we have very much taken into the core of our investment process. And therefore, you'll see in our positions that we have been tilting and leaning into, exposures that have provided more resilience in, market volatility historically, and ultimately better performance. And I think you'll see that in both on the bond side and on the equity side, where we are adding that additional, exposure or complement through more sustainable building blocks. And again, I think if you look out over the next 10 years, our view is that there is a significant transition towards, a greater focus on sustainability. In practical terms, we do think that those companies that are more greener will be, rewarded more than those companies that are less. And in particular, they'll have a lower cost of capital. And therefore, the expected return on those companies is going to be higher. Things about, and it's not just the climate sensitivity, but also, thinking about, in the world that we live today, governance has always been important. If you look at some of those scandals that we've seen, whether it's Facebook or Wells Fargo, and then, the social side, and I don't want to underestimate the impact that, the pandemic has changed the social, contract, and therefore really, making sure that we have exposure resilience in our portfolios with greater, sustainable focus. Of course, the portfolios that we run are not, focused on delivering an improved ESG score. We do see these as complementary exposures, and they're also complementary to other assets that we have in the portfolio, such as gold. I've held gold for many years. It's an asset that is plays a role in diversifying a portfolio, diversifying within the bond space, particularly when, real yields have been negative. That's when gold has come into its own. Obviously, the world is moving a little bit. It's moving, into a higher yielding environment, and that's where the opportunity cost in holding gold has been a bit higher, and therefore, we've been reducing some of our exposure to gold over the last couple of months. We still maintain it because we do think it has some inherent inflation protection, but just not as much as we've held in the past. So that's, again, just reiterating, kind of the macro views are important. That's really helps us position, but what we're really looking to achieve is, a risk profile that's aligned to a client's kind of return expectation, and try to maximize and diversify our exposures within equities, within bonds, and look at other asset classes that we can add, and other types of exposures to really deliver that improved outcome. As I said, sustainability is something that we've been really building and leaning into over the years, and therefore, you wouldn't be surprised to see greater exposure to more sustainable companies in the portfolios over time. I'll pause there to see if there are any specific questions, David, or any areas you want me to cover.
Andrew, yeah, thanks for that. There are a few questions I think that have come up where we've been speaking to investors, and maybe just to sort of deal with them. The first one's about inflation, and we've seen this sort of extraordinary fiscal and monetary stimulus in the US, combined with what you see, what BlackRock see as a restart rather than a recovery from COVID, and also this massive amount of involuntary savings that I think has been reported. Can you give us your thoughts about whether inflation is a real risk, and how you're positioning particularly the non-equity parts, well, in the whole portfolios, but how you're positioning them, the non-equity parts, in view with your thoughts about inflation and real yields?
Yeah, look, inflation is it's the bogeyman. It's something I tell my kids with their seatbelt. You can't try and time a seatbelt. You got to have it on at all times. And I think thinking about inflation in that light is important. Inflation, when inflation hits, it's too late to start thinking about it. And therefore, you always want to have some element of inflation protection in your portfolio. It's just very difficult to time it. I think there's a realized, I think one of the benefits of London opening up a bit now is because you actually feel inflation, because when you go out to the pubs or you go out to the restaurants, prices are materially different. And that's going to feed through to the economy. That's going to feed through to the investments. And what we've been doing in the portfolio, said we've held assets like gold over many years, and we definitely see that as a potential. But specifically in the bond side, we have been tilting and holding inflation-linked bonds. Again, there are very little, there are a couple of areas that you could go to, but holding things like UK gilts, hold things like tips, in the right proportion is important, because you remember they bring a lot of duration as well, which is not a bad thing in a multi-asset portfolio, but it's something that you just have to manage. So you'll see in the portfolio, positions in inflation-linked bonds, upwards of, I would say in the more conservative, more fixed income heavy, they're diversified. But as you move into that higher risk or higher equity profile, you'll see larger absolute weights in inflation-linked bonds, upwards of 7% for a more higher equity risk profile, and that just shows you that what we're trying to get is that inflation protection relative to other nominals, but also recognize that we can get some diversification through duration, particularly in an environment where gold is perhaps not playing the diversifier to equities that we want. So yeah, nice combination of fixed income assets. It's really about recognize that we're not going to lean into, all into inflation-linked bonds just because, we think that there's inflation risk. It does mean that we will have an exposure to it. And I think that diversification story is what's, that is what we're really looking for.
But the other one is we've seen a lot of equity markets not just recover from COVID, but now make new highs. Do you see this the strength in equity markets as being part of a bull market run that's going to continue as markets respond to the fiscal stimulus and so on, or are we entering into bubble territory in equity markets?
Yeah, I won't go academic on the bubble territory thing because it's very difficult to forecast. But look, it's all relative, right? It's in an inflationary environment where there's an expectation for some. Clearly, you can't just rely on equities. You have to try to build, but equities do play a role in that. The other thing that we've talked about is this restart. It is generally a kind of a new era, and therefore people are going to be spending. Consumer spending is going to increase. It's you're not going to go out and just sit in the park. You're going to go out and spend money, and that's going to filter down to companies, and they're going to charge you more for the goods that you buy, and that's going to all feed into into profit margins and corporate earnings. So we do think that equities are a place you want to own. The question is how much of it you want to own. And I think, it depends on your time horizon. If we are taking a 10-year view, equities, particularly sustainable equities, and again, looking at specific sectors, I think is important. So not necessarily buying the sector, but recognizing that some sectors will outperform others. Some regions that have that sector bias will outperform others. And again, you can take the view here that, things like healthcare, there's going to be, significant spending, both government and corporates in the healthcare sector to protect the ability to people to stay out and enjoy life in this new world. And there are other sectors that are just not going to benefit from this kind of green stimulus that we're seeing generally across the globe. And you have to recognize that those sectors are likely to underperform. And therefore our view is, you want to own equities, you want to own it in the right proportion, but you also want to be clear the types of equities that you're owning, and make sure that they benefit. They give you that bit of inflation hedge, but they also give you, that exposure to those sectors, those economies, those corporates that are going to do well over the next 10 years.
Yeah. Final question, Andrew, and just sort of pick up on BlackRock's view on investing in China. There's obviously very pertinent for IPP and their clients, based in Singapore. China's an interesting investment conundrum. BlackRock, I think, talk about a sort of increasing polarization of the world between the US sphere of influence and the Chinese sphere of influence. What are what are BlackRock's sort of general views on investing in China?
Yeah, I mean, it's an area that we've been invested in for a long time. From a portfolio perspective, we've had on the fixed income side exposure to Chinese government bonds. On the equity side, we've clearly been overweight emerging markets, which has benefited from Chinese exposure. I think the sentiment purely from a sort of data perspective has come down a bit. So while we still overweight emerging markets, we would have a less positive view on China at the moment. But clearly, as things move out, over the next couple of years, that's going to be a really interesting and exciting place to be. And we can definitely see, again, theoretically, from a market cap perspective, China playing a bigger role in our investment opportunity set. And then again, it's just really about being, selective with when you own it, when you don't own it, or how much you own it again. But yeah, it's an area of significant interest to us. The technology side is very interesting. The yield and credit trade-offs that you can get on the fixed income side are very interesting. And on the equity side, look, it's clearly an area to keep an eye on.
Yeah. Okay. So final question on a scale of, let's say, a sort of -10 to +10 in terms of your outlook for investment returns. Where on that scale of -10 to +10 would you think BlackRock are at the moment?
And I just got to be very careful if I understand what you mean there. Are you saying expected return 10 or
let's say -10? Let's say -10 would be catastrophically bearish, sell everything, go and live in a bunker, and +10 would be to mortgage the house and double up and be fully invested.
Yeah, no, we're definitely in the positive territory. I would say we are somewhere around the kind of 4 to 5. We're not. I mean, and again, generally that's why we stay diversified, right? So it's unlikely we'll ever get to 10, right? Because clearly we're going to own bonds, and the expected return on bonds is going to be lower. So it is really owning that space between your 4, 5, and 6, maybe 6 depending on the weather and how much coffee I've had, and I'd say a 4 is the kind of prudent risk management fiduciary in me. But I would say we are generally positive on risk assets. It's just really understanding, unlike the last few years where it didn't really matter what you owned, everything was generally trending. You got to be a little bit more selective, and I think hopefully that's where we can bring some insights, we can bring some views that, of course, not all of them are going to pay off, and it depends on the time horizon, but that diversification story is going to be really important. So monitoring things like correlations, monitoring how different asset classes are opening up, thinking about regulatory risk, thinking about how things like pandemics are going to hit different markets. And again, look, try and do as best we can. I think fundamentals for me are, it's about staying invested. It's not about trying to time the markets too much. It's not about trying to be overreactive to this data. It's important you have the data, if only to hold your conviction as to why you stay invested.
Okay. Well, look, Andrew, I think as ever, you and I could go on talking for forever and ever about markets and economics, but many thanks for that. And if you don't mind just hanging on to like 15 minutes in, because I'm sure then there'll be some questions coming from the audience that I'll be directing your way. So what I'll do is I'll now go back to sharing where we were in the presentation, and we'll look at how we can get to our 4% solution. So we left the presentation with me sharing this rather gloomy slide with you all, which was talking about the natural yield on different asset classes and how the yield that investors get has gone down. So for income-seeking investors, there is a real conundrum. Do you take the extra risk of investing in credit or investing in equities in order to get high yield, because the returns on conventionally assets that would normally produce a high yield of now not doing that anymore. And what we can see from BlackRock is this weight of analysis and input and insight that BlackRock provide. BlackRock are forecasting ranges of returns from different assets, and as you can see, it's probably not as crystal clear, but on the left hand side we're looking at the sort of the likely range of returns you're getting from bonds, and it's the returns from conventional income producing assets, we think are likely to be sort of below average and let's call it disappointing. So what is the solution, and why do we think we have a solution that works for income seeking investors? Well, we know there is demand from investors for funds that offer regular payments. What investors are looking for are high sustainable income payments over the medium to long term. There's no point in having a high income that burns out or doesn't last. People want a security of income, and ideally, I think people are now anticipating that they will be living off their portfolio for a significant period of time, hopefully a significant period of time. And so people want to have both a chance of increased income payments over time, and we think investors want their capital value to be preserved or hopefully grow as well. And sequencing risk is a rather technical term, but it basically refers to the fact that you don't want to be in a situation where, in order to generate the income you need, you have to sell more of your portfolio when markets have gone down, which means you have less of your portfolio left when markets recover. So in terms of trying to do this, I think one of the points that Andrew mentioned was the benefit of diversification, the benefit of having exposure to the right mix of equities and bonds and alternative assets, to be in the right sectors and the right markets and so on. And generally, you want to have equity assets, right now, in order to benefit from the growth that we're expecting to come through. So the Oak Multiasset Funds offer a solution which we think works for income-seeking investors. We have across the fund range, as I mentioned earlier, on a lower, a medium, and a higher risk fund. So the low risk fund has 40% equity, the medium risk has 60%, and the high risk has 80% equity. The funds are all invested in a diversified portfolio of equities and bonds, and the asset allocation for the funds is driven by the guidance we get from Andrew and the team at BlackRock. And so we're able to lean on their enormous expertise and experience in this market to drive the asset allocation. So they're giving us asset allocation, which is basically trying to say what's the best mix of assets, of equities and bonds, in order to get the best risk return profile. They're not giving us an asset allocation that's specific to income. They're saying let's find the mix of equities and bonds that's giving us the best best return for the level of risk we're taking. And what we have within the share classes, within the funds we offer, is each of the funds has share classes that pay a distribution or a dividend that is equal to 1% of the net asset value of that fund each quarter. So each quarter there's a distribution from the fund. That distribution is equal to 1% of the value of the fund at that time. So that's giving us a 4% per annum income. So what we have with the distribution share classes is we have a distribution policy, which means that investors receive a quarterly income. That quarterly income is absolutely a function of the growth or the current value of the fund at that time, and that income will be 4% of the net asset value. Now, what you can see from the slide on the left, which is a simulation of how things might perform in the future, the top blue line reflects the total growth of the fund, if you like, the net asset value of the fund. The grey line underneath it is the capital value of the fund after the distributions have been paid, because obviously as we make payments from the fund, part of your assets, part of your investment in the fund will be returned to you, and so the remaining assets that are left within the fund will reflect the fact that you've received the income. And the bar chart at the bottom shows the sort of the income that the investors receive, and you should read the income off the right hand side here. So the important point to note here is the income that you get from these funds is not fixed, but is variable, and the income varies in direct proportion to the value of the income share classes. So what we're able to do with this is we are able to provide a regular income paid in quarterly installments. As the fund value rises, the income that we're able to pay out will increase, but you should be aware that if the fund value were to fall, the income would fall at the same time. So in order to benefit from the magic combination of rising income and rising capital value, what we're looking for is the fund to generate a return of more than 4% per annum. And if a fund generates more than 4% per annum return, then investors in the income share classes will benefit both from a high and rising income and indeed a rising capital value as well. So we've got a huge range of income share classes, and one of the benefits we have here is rather than just having one income fund, we've effectively got 3 income funds, and within each of those income funds, we've got income share classes in euros, sterling, dollars, and Sing dollars, and all of those income classes offer a payment of 1% per quarter or 4% per annum. I've got some simulations here about how the income share classes would have performed. And you can see that the numbers here, this is for the M80, which is our highest income paying share class. We can use the real returns from BlackRock. BlackRock have been managing these model portfolios for a long time, and we've been able to recreate how our funds would have performed based on the actual real life BlackRock track record all the way back to the beginning of 2017. So we have simulated returns up until February, where the first of the funds was started, and then we have the realized returns from that point onwards. So you can see this is the total return from the fund in sterling and in dollars, and you can see how for the highest risk fund, MA80, the fund has generated 9.8% in dollars, with a volatility around 13.1%, and so the BlackRock returns have been very, very good over this period. Underneath it, we show the dividend payments both in dollars and sterling, and you can see the total payments that have been made in each calendar year. And so if you like, this is assuming you've invested $100 on day one. In 2017, you'd receive $4.24 back, so slightly more than the 4% of your initial money. And you can see how the dividend progressed. Now, what I think is interesting is if you look at the 2020 total here, you can see that the 2020 total actually went down slightly. Now that reflects the fact that, in 2020, we obviously had the catastrophic fall in markets as a result of COVID. What that meant was that the dividends paid will have been reduced slightly, but then you can see that in 2021, there's been a sharp uptick, and the first simulated dividend payment we had would have been back up to 1.19%. So if you compare the dividend that would just have been made in March through to the first dividend, we've seen a 14.18% increase in the sterling dividends and a 22% increase in the dollar dividends. So this ability to pay the 1% of the current net asset value means that, yes, your income flexes when markets go down, but is able to recover as markets bounce. We've got the same analysis for our medium risk fund. And as you'd expect with the medium risk fund, the overall returns are lower, the volatility, if you like, or the risk is lower, and the growth in dividend payments is also been lower. And when we look at the lowest risk fund, this is a fund really set out, for the more cautious investors, people who want less volatility, less downside. The returns are lower, but the volatility is also much lower. And in this case, the dividends, have been largely stable, flat in dollar terms over the period. So what this is showing is how these dividends and how the capital growth would have performed over the period since the beginning of 2017. And I think hopefully it shows that these funds are delivering pretty much what we planned them to do. So the dividend payment dates are all set out. We are essentially, dividends are paid to investors who own the fund on the 15th of March, June, September, and December, and they're paid a couple of weeks after that. So just in terms of I think it's important to understand what the risks and returns are, or risks and benefits rather, of this. As far as the benefits are concerned, because the dividend rises and falls with the net asset value, we don't get in a situation where we end up essentially selling too much of the portfolio in order to generate the current level of income, and that takes away what's called sequencing risk. You've got the potential for income to rise over time, and the dividend policy also means that the dividend will be maintained through for the very long term. The fund, because it is investing in a total return basis, we don't have exposure to dividend cuts, and indeed we are not necessarily hampered by the very low level of yields on fixed income assets as well. And we've got the potential both of rising income and indeed rising capital value. So I think if you like, the positive side of the balance sheet looks very encouraging here. On the risks, and I think we need to be aware of the risks, investors need to be aware that their income will vary, that both the capital value and indeed the level of income may fall if the investment returns are not sufficient, and so you are exposed here, to risk both the capital and income. So that's pretty much where we've got to. I'm sure that you will have lots of questions, and what I would encourage you to do is to contact your representative at IPP and speak to your financial advisor, or indeed, if you've got questions for us, please feed them through, and we'll do our very best to answer your questions. But I hope you found this an interesting presentation. I'd like to just sort of close off by thanking Andrew and the BlackRock team for continuing to support OneOak in our development of these funds. I'd like to thank IPP for the kind introduction and the ability to speak to you all today. And I'd like to thank you for attending. So thank you very much, IPP. Thank you, BlackRock. And I hope this has been interesting for you.